Fed has got to regain its credibility that it is serious about inflation fighting.
We're dealing with a little bit of a stagflationary environment here.
I think it's important to realize that we got a lot of emotion here in this market.
Investors have become very accustomed to good returns, low volatility, and always being supported by the Fed.
This economy is not falling off a cliff today, and actually is quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A most extraordinary Monday. Kaylee Lyons in for John Ferro as well. We welcome all of you on radio and television worldwide to Markets to Be Polite on the move. We'll get to the data check. Dow negative 599, out 5 big figures on the VIX. But Lisa, I want to get right to the distinction of the moment. This is not about the stock market. It is about declines in both equities and bonds.
And what you see is on the front end, people saying the Fed has to do more. Central banks have to do more. The inflation read that we got last week did not give anyone comfort that it was decelerating. And not just that, but inflation expectations among consumers starting to become a little bit less moored. You're starting to see them climb in a way that they haven't since 2008.
You know, I look at the drawdown. Let's get right to it, the buy part here. I'm going to go to the Dow a lot today just to harass John Ferro. But also when things get ugly, people mentally switch over from the Pro Index, the SPX, with the VIX. We quote the VIX, 5 big figures, but they go to the Dow sort of as the mother lode of decades and decades and decades of these moments. And Lisa, we've got a drawdown Dow negative 16% and full faith and credit bonds negative 13%. Guess what? I've never seen that.
No, you've never seen that. I've never seen that. I'll point to another index, just not to tweak John Ferro so early in the morning, looking at the Nasdaq. If you take a look, it's down 27% year to date. It's about down nearly 3% at one point ahead of the market open in futures. That would bring it down, getting closer to that 30% drawdown, Tom. If you want to start looking at massive figures, these are massive figures at a time when markets are recalibrating to a central bank, all central banks that have to do more.
Little longer data checks today. Kaylee, I want to get to you on the economics and the politics of an adjusted Fed. We'll talk about inflation expectations on Friday, which shocked economic Wall Street. But Kaylee, Greg Valliere publishing moments ago. Thank you, Greg. You were going to be with us today and stepped aside for the global Wall Street pros. Greg Valliere says 75 basis points more likely in July. So, Kaylee, is that 50 now and 75 in July?
That's at least what the market pricing would indicate at this point, Tom. 175 basis points by September is what traders now expect. So in all likelihood, that is at least one 75 basis point move. Of course, you have Jeffries, Barclays saying that 75 basis points could actually come this week on Wednesday. There is a question, though, Tom, of if this Fed still wants to keep expectations in the market in line with what it does? Or is this a Fed that, given the upside surprises in inflation, is going to become a little bit more willing to take the market by surprise? The
Fed decides Wednesday. We will be there with coverage in the afternoon of what has all of a sudden become a more than important meeting. I want to go through the data check now. Lisa, you can wander to the wall and, use my walker, Lisa, if you have to after the wild weekend you had. But let me talk about the data check right now. S&P futures are minus 93, Dow futures at negative 600. Everything correlates. Maybe gold's a little off the mark with the VIX out 5 basis points. The yield structure is absolutely original. And because Lisa and I miss John so much, we're going to start with the Italian yield popping out. And on a deviation basis, chart banner, I think you've got this banner. The Italian-German spread is a great European litmus paper. And it shows 2 things. One, AC Milan won this year, and it also out 2.7 standard deviations. Dollar strength, we'll get to Mark Chandler in a moment, with yen beginning to look at 135, euro 104.58, and sterling to end at 122.02. My word, a 119 sterling, Lisa, we are unprepared for that. What do you have?
We are unprepared for the week ahead. And really what I usually do at this segment is talk about what to expect in the day. But right now, the day is all about markets, and it's preparing for what to expect this week. Wednesday, we get that FOMC rate decision at 2 p.m., and Fed Chair Jay Powell gives his news conference at 2:30. This is the reason why 2-year yields today are popping to the highest levels that we have seen since 2007. They have exceeded 3% and have continued onward to 3.2%. The pace of move has been dramatic, and suddenly we're talking about a 75 basis basis point rate hike getting baked into expectations possibly as soon as July. This is a fast-moving market, and it is doing it on the heels of inflation expectations. And if you take a look at the University of Michigan Consumer Sentiment Survey on Friday, this is what caught people's attention, that the 5 to 10-year inflation expectations rose to above 3%, 3.3%, the biggest move and, frankly, the highest level that we have seen going back to 2008. People are expecting this inflation to be sticky. Thursday, the Bank of England rate decision after today, what we got in the economic data front that was really not comforting, considering the fact that it's the second month in a row that they've seen negative growth in GDP. What you're seeing on the two-year yield, yes, you are still seeing it rise to the highest levels going back to 2007 in the United Kingdom, 2.1%. But over the longer term, people are bringing back those expectations because they do not see a good outlook for the economy. They are hiking into weakness. And then Friday, I normally wouldn't be talking about this. The Bank of Japan policy decision. What's the policy decision? Keep things where they are. But right now, the policy decision is being driven by the yen. And Tom, you talk about this all the time. The weakening in the yen is a linchpin of global markets. And that linchpin is telling you that right now we are looking at diverging monetary policies that are unsustainable for Japan. You can see the yen weakening at one point. It's the weakest since 1998 this morning. And this comes as they keep rates where they are. They try to manage that market, which is no longer a market, and it's being borne out in the FX market. That's sending a pretty strong message, Tom. One
board to get through the morning here, and I really want to introduce this as somewhat of what I see in the Launchpad board. The VIX out 32.85, 5 big figures. The Dow, you end up flipping to the Dow in times of crises, and here we are, negative 589, a little bit worse earlier. The 2-10 spread was negative a moment ago. Now 3 basis points is infinitesimal. We are back to a level curve. And Euro Swissy was a 103 handle here coming on up. Right now, Mark Chandler joins us, Chief Market Strategist at Bannockburn, and just wonderful at the astrology of the market, an acclaimed book on the stars, the astronomy of our market a number of years ago. Mark Chandler, what is the item you're watching to glean the astrology of the market?
I really think it's a question now of momentum. I think you guys are right. The Fed funds future, they're pricing in 175 basis point hikes in the next 3 meetings. That implies a 75 basis point hike sometime in the next 3 meetings, counting this week. So I think that the dollar's got a lot of upside momentum here. And I think that the talk of intervention still seems to be misplaced.
So, Mark, when we look at what's being baked into the market, have we reached peak rate hiking expectations? Have people gotten over their skis in terms of the hawkishness? Or are we looking at a game change for the Fed where suddenly they have to respond?
Well, I think that the Fed, I know that a lot of people are critical of the Federal Reserve, that they've lost credibility because it's so far behind the inflation curve. But I think that, to your point, we had 2 numbers last week. One, as you mentioned, the consumer confidence, the consumer number for inflation expectations jumped. And at the same time, the consumer sentiment fell to levels that are associated with recession. And the market believes, has a lot of conviction, that the Federal Reserve is going to follow the inflation expectations and not the potential sluggishness, possible contraction in the U.S. economy. Remember, we contracted in Q1 as well. And so we could possibly be having second quarter of contraction here. But the market's convinced the Federal Reserve is going to become more aggressive rather than less aggressive in the face of this economic weakness.
Okay, so the market is becoming more convinced about more tightening from the Federal Reserve, Mark. It is not looking for any tightening coming from the Bank of Japan. When is Kuroda going to have to give in with a yen that hit the weakest since 1998 earlier today?
Well, to your point, I think that the Japanese comments have been very clear. They're not concerned about the level that the dollar-yen's gotten to. They're concerned about the pace. And so what's the appropriate tool for the pace? Might not be actual material intervention or a change in policy. If anything, it seems that the BOJ is doubling down on its policy, reinforcing the idea that it's going to cap the 10-year yield at 25 basis points. It did so today, even though the yield got a little bit above there, and they increased their bond buying for tomorrow. And so this tells me that the Bank of Japan is not about to change their policy, and that the yen weakness could be addressed by the talking about it, that is to say, a very low level of on the intervention escalation ladder, just taking a small step on that. I think we really have to wait till the G7 meeting, the G7 summit later this month, for the G7 to also endorse the idea that while markets should determine exchange levels, that volatility could be undesirable. And that's where we are now. So I think that's a question of verbal intervention, not a change in monetary policy.
The volatility question mark is absolutely key. How does renminbi fold into that? I think it's overplayed in the zeitgeist, but nevertheless, it is the Chinese yuan.
Yeah, so today the dollar gapped higher against the Chinese currency. And what's happening there, I think, is that many of us thought that maybe that COVID zero policy was being effective and that Beijing and Shanghai were going to reopen. But today, a big setback. Beijing schools opening have been delayed, more lockdowns and restrictions introduced to Shanghai. And so I think that a part of the issue, I think, is broad dollar strength. The other is a bit of disappointment with what's going on in China.
Mark Chandler, thank you so much on short notice with Bannockburn today. We're really trying to blow up the show here, folks, to give you the market coverage you need with futures at -88, Dow futures -563. Lisa, I think all of us realize the import of the University of Michigan inflation expectations numbers. I sold them on Thursday and Friday as well. Chuck Banner, give me the banner here. And for radio, I'm going to talk this through. June of 2008 is the last time we were here. And Lisa, what is shocking is we went to a 2.2% inflation expectation just before the pandemic. It is amazing how far we've come across the pandemic.
The surprise for a lot of people was how much it ticked upward, despite the fact that the Fed has talked about their being aggressive. And this is what has gotten people concerned. Consumers are going out there. They're filling up their tanks. They're seeing it's $100 or more, given how quickly the gas prices are moving up. And that is unmooring expectations well beyond where the Fed wants them to see.
For those of you for and against Bitcoin, we will keep you abreast of that move. It's bouncing now off the 23,000 level, just above 24,000. Stay with us. More market coverage, more data checks this morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes. But Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential elections from his result 5 years ago. A software engineer on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the project. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he breached the firm's confidentiality policy. And crypto lender Celsius Network paused withdrawals, swaps and transfers, triggering a broad cryptocurrency sell-off and prompting a competitor to announce a potential bid for its assets. Doubts about the high-yield backing products, such as those Celsius offers, have intensified after tighter monetary policy across the world helped curb demand for riskier assets. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I think you've got to be very modest about what we know about this inflation process. And I fear that it's still going to get worse. We may well get to 9% at this rate.
9% inflation. Are you ready for that in the United States of America? There's a few other places that are feeling that right now. Maybe we'll see some chat on that out of Europe this week, but really extraordinary. We welcome all of you on radio and television. Lisa, quickly here, Bitcoin can't find a bid, just down to new lows under 24,000.
Honestly, we didn't get the best quote this morning from our previous guest saying that it's amazing that something can fall that's worthless. So people are looking at how far this is.
There's a lot of people, not that I know anybody. I'm asking for a friend, Lisa.
I mean, look, I think it's fascinating to me just to see the froth taken out of the market. And it goes back to that Warren Buffett quote, right? When the tide rolls back, you see who doesn't.
They came to me and said, do you want to do the crypto show? And my people told them, that would probably not be a good idea.
Just rail against
Kaylee Lines doing the crypto show. Kaylee Lines, how big's the wake this week for the crypto show?
It's going to be interesting. Tuesday, 1 p.m. So don't forget to tune in tomorrow afternoon. But Tom, Matt Miller and I have been joking for weeks that Bitcoin has become terribly unexciting. We've just been in this range in and around $30,000. It is a lot more exciting with a breakdown below that range today.
Joe Matthew memorized everything Everclear ever wrote, including so much for the afterglow. And we will get the afterglow right now with Mr. Matthew in Washington on these hearings. Joe, I really want to pause in the market carnage that we've got and talk about the next hearing. How will the hearings today theatrically be different than the splash of last week?
The theatrically may not be different at all, save a much smaller audience. We're not in prime time. It starts at 10 o'clock in the morning today. So lawmakers on this panel have their work cut out for them, not just trying to get into people's living rooms and lives at 10 o'clock in the morning, but also to compete with stories like what's happening in this market, what we're hearing from China today, though. They begin the process of connecting the dots. Think of last week as, opening statements. Today, they get down to the actual process of connecting the dots between when Trump was told by his inner circle that he had lost the election and in fact was losing it. He heard this long before January 6th. And the pro-Trump supporters who turned into a mob here, the witness that we're going to be watching today, Bill Stepien, former Trump campaign manager in 2020, about these behind-the-scenes conversations we keep hearing about.
And Lisa, meanwhile, there's actual news, including the distance from an island off China to the mainland.
Right. I mean, if we weren't talking about inflation this morning, we'd be talking about Taiwan. And what China said over the weekend, that basically the Strait of Taiwan is not international water and that they will command over it if there is any kind of untoward interference from other nations. A direct shot across the bow to the United States. Joe, how concerned are people in Washington?
Yeah, the defense minister in China definitely using the words fighting here with regard to Taiwan. It comes just a day after the Secretary of Defense, Lloyd Austin, made some comments of his own, talking about the U.S.'s Indo-Pacific strategy and how it prefers the status quo when it comes to Taiwan. Look, this is another layer in an ongoing conversation here, a standoff, a dispute, whatever you want to call it. It's decades old. Just more recently, though, has really come into heating up into a war of words here against the backdrop of the war in Ukraine. We really haven't heard much coming back from the administration on this, but stark language coming from Beijing this morning.
Yeah, and as Lisa says, on any other day, Joe, that would probably be a much larger focus. But the fact of the matter is this is the day after the inflation print of Friday, which is a huge political problem for the Biden administration. Yet as they point the finger to the Federal Reserve and say it's their job to rein in inflation, is it a worse political problem for the U.S. if the Fed acts aggressively and as a result you get a higher unemployment rate and potentially a recession?
Boy, that's the $30,000 question inside the West Wing right now, and it's one that the White House would prefer not to answer publicly, thus deferring to the Fed. The president will be talking a lot more about inflation this week, though. He's going to be going to Philadelphia to speak to an AFL-CIO convention tomorrow. To check out the language here in the White House schedule that we got. He's going to talk about building an economy, they say, around the power and possibilities of working people. An economy that rewards work, not just wealth. That should give us a sense of what we're going to be hearing here as the president prepares to talk to this again.
Joe Matthew, thank you so much. Greatly, greatly appreciated. That's great, folks. Well, Joe's yammering away. I'm looking at my portfolio go down in South. Being in triple leveraged all cash actually feels pretty good here. Joe Matthew, 5 p.m. today with an important show. Lisa, we talk full faith and credit, and it can be the quality of the U.S. or maybe what Italy's doing, 4% yield on Italy. Lisa, I'm only down 68% on my 100-year Austria piece.
Congratulations.
Right now. How about that credit? How is credit corporates doing in America?
So this year, credit's actually done better until about a month ago in terms of how much the total return has been relative to government debt. That is starting to change. I'm looking right now at the average yield on high yield bonds, on junk bonds, and this hasn't been high yield for a long time. You're getting nearly 8% yield on average from U.S. high yield bonds now, Tom. This is indicating, yes, that people are concerned about credit. They're also baking in a bigger cushion for higher yields. But this is the conundrum that a lot of people face. We are not facing into a big maturity cycle. Yeah. What's going to make them default? You still have good balance sheets. People are trying to bring forward a recession that has yet to happen, and people are looking at the bottom line and not seeing it in credit. And this is why the Fed's going to keep going.
If you're just joining us on radio and television, we'll do a lot more in the markets today and more data checks. Futures at negative 91. Dow futures were negative 600, now negative 590. The VIX out 5 big figures, well over 30, 32.81 with dollar strength. Sterling, is Ferro paid in sterling, Lisa?
No, he's not. He's paid in dollars. He talks about this all the time. He has a certain level that he'll go back into sterling, but no.
Okay. You know,
not that anyone's trading.
Yeah. 122.11.
Why don't you go and quote the Dow again? See if he writes in sterling.
Kaylee, you know, Lisa's all wound up about, you know, when you Kaylee, I don't know if you know this, Lisa's got the H2 to do the portages up by Tupper Lake, and the EBITDA on Exxon has moved from 27 billion to a modeled 88 billion. I guess they're making money, and Mr. Biden mentioned that this weekend.
Yeah, that they're making more money than God. This is something he has repeatedly come back to, is that these energy companies are the ones that are responsible for higher prices at the pump. He says they're prioritizing profits and returning capital to shareholders over the American people. He is looking for someone else to blame other than his own administration's fiscal policies, which is why also, as we just discussed with Joe, they're trying to point the Fed to the Federal Reserve and say, your problem to fix, or maybe energy companies, you fix it as well.
Lisa, are you filling up, or are you like doing the top thing where you drive and, you know, you spend $22 and then you drive some more and you spend another $22?
True story. We actually ended up trying to empty the tank as much as possible to see how much it would cost to fill up the whole thing as a science experiment. So we were on the highway just saying, we hope that we don't run out of gas. Please don't run out of gas, because we wanted to do this science experiment. It was great. We had all the kids in the car. It was fabulous.
32 gallons, top ticket, folks. She got some Matt Miller gallon of gas. It's like Shell, super duper. I think she's out of $250 to refill the H2. We're watching the markets here this morning and the underlying economics of them, with futures at negative 90, the VIX 32.79. On Chairman Powell, Francis Donald next. This is Bloomberg. Stay with us. Everyone, Bloomberg surveillance on radio and television, an historic Monday, no question about it, with the VIX out 5 points, 32.78 on the VIX. Futures at negative 90. As a side story, Bitcoin tanks. No other way to put it. Lisa, let's do this very, very quickly here, and I want to talk about curve inversion. Here's a board I'm looking at that's got a lot of good stuff on it. The 10-year yield is 3 basis points above flat. Crude is off, showing that global slowdown feel. Euro comes down just to a 104, and futures negative 90. Lisa, what's the symbolism of inversion?
At this point, right now, stagflation, possibly recession. I say stagflation first because we haven't gotten inversion, and we flirted with this level before, and we're looking at a Fed that is now expected to raise rates by 75 basis points as soon as July. And not just that, but I was looking at a Deutsche Bank projection, and they expect that peak Fed funds rate right now is going to reach 4.125% in 2023. That is a level we cannot even comprehend given where markets have been over the past few decades.
I have been data dependent. I've been criticized for calling it a Fred Parler game. Francis Donald agrees with me, because Francis Donald is writing brilliant economics for Manulife Investment, asking if her mother-in-law knows who Chairman Powell is. And you note, Francis, that your mother-in-law will drive, she's lovely, by the way, folks, she'll drive 30 kilometers out of her way to save 10 cents a gallon. How does Chairman Powell speak to your mother-in-law?
Well, he's not. He's tried. He said, let me speak directly to the American people. But the big challenge for this Federal Reserve is that inflation expectations, which they're so desperate to control, are really not going to come down, at least in the near term, on rate hikes. Most of the general public is going to see what they're paying at the pump and what they're paying at the checkout, and simultaneously hear that rates are rising. This is going to be a very different communications or very difficult communications challenge for all central banks. They don't have the luxury of being honest about what control they have on inflation. That's the underlying problem facing Chair Powell, Lagarde, and many other central bankers.
Chairman Bernanke on CNN this weekend. Let's get out his textbook, Abel Bernanke, which is in my hallway at home. Francis, I look at Abel Bernanke, and back in chapter 22-ish, it's about the effect of what the Fed does on finance. If they pop 75 beeps now or July or whenever, what does that do to North American banking?
Well, it's a struggle, and it's another strain on the system. We could be inverted on the yield curve again by today or tomorrow. And unlike back in April, you're not going to hear as much pushback that this isn't a signal or a precursor to a recession ahead. Financial conditions are tightening. The economy is slowing. The consumer looks fine now, but all leading indicators suggest it's lower. Geopolitical risk is up. If you made a whole table of challenges for the economy, almost every single one would tell you that for the next 6 to 12 months, things are going to be much more challenging. That's why this is such a difficult situation, because despite all of these leading indicators, we have not seen the central banks blink. In fact, last week we saw most central banks that were speaking actually appear even more hawkish. So the hope that bad news would be good news and to create a reversal in this market, it's just falling away in front of us.
Francis, consumer sentiment at its lowest on record, and your mother-in-law driving 30 extra kilometers to get 10 cents less on a gas can drive around and see a lot of variation as things just climb higher and higher. Francis, at what point does it have to reach peak negativity before you get some response from the Fed that can really address this? Because right now they're between a rock and a hard place. If they actually come out as hawkish, perhaps that will create better sentiment underpinning markets and consumers.
This is a great question. I mean, macro tends to be most valuable at inflection points in the story, and we're not at an inflection point just yet. We haven't seen a blink from central bankers. We haven't materially seen employment start to rise, although some leading indicators suggest that gets better. Now, consumer sentiment, there's a range of indicators. A lot of people focused on University of Michigan last Friday. Consumer confidence, which weights a little bit more towards jobs, doesn't look as bad. But the challenge for consumers is we're going to get retail sales numbers this week. And in nominal terms, they might look just fine, and you'll hear a lot of the consumer is good narrative. But in real terms, every single month, this is a consumer that loses purchasing power. And now initial jobless claims starting to move up, so they're losing purchasing power, and they're going to start worrying about their jobs. That transition from capital to labor, well, it's looking like it was very short-lived, and that's really the biggest challenge facing this consumer right now.
Francis, Mike Wilson over at Morgan Stanley came out and said people are not pricing in the consumer weakness that we are going to see, given exactly how much their budgets are being crimped. You have Lori Calvasina of RBC saying that if we break through the lows that we have seen year to date, we could get down to 3,400 pretty quickly on the S&P. Do you think that this is all accurate, that people have not taken into account how much the disposable income is getting eaten into?
Two of my favorite strategists, two very good calls. That's the challenge here, is that the narrative has been for the last 2.5 years, there were huge stimulus checks. The balance sheets look good. Debt service ratios are fantastic. But actually, real wages are declining. We're going to start seeing challenges in jobs. And that age-old idea, oh, the balance sheets are really solid. Well, that's where they are now. But where they're going to be in this next 6 to 12 months is more challenging. So that brings me to the question of when does the central bank really start to pivot? And it looks like what they're telling to us is they can't do it until inflation mollifies. What I'd like to see from Chair Powell this week is maybe some Yellen-type comments. We want to focus a little bit more on core as opposed to headline, and reminding the general public, whoever is listening, my mother-in-law will not be listening, that they can control some segments of inflation, but not other ones. That would be sort of the beginning ceilings of what we could hope for in terms of a pivot ahead. But generally, I don't think this Wednesday we're going to get it. And that's why we're not yet at an inflection point in the macro story.
Are we going to get a hint that 75 is coming in July, Francis?
Oh, I'm not sure. I mean, central banks are trying to open the door. The Bank of Canada did it last week. Previously, they'd said, oh, we're not interested in 75 basis points. And then when asked if they would raise by 50 basis points, they said maybe more than that. I think these are central banks that want full optionality. What we might get, which might be helpful, is a little more symmetry in that optionality. More talk about a September reassessment could be very valuable. But again, I don't think we get that this week. We probably need much more indication that inflation expectations begin to cool.
Well, they're definitely not cooling yet, Francis. And as you say, the Fed can't be responsible for reining in all of the factors contributing to inflation. They can't do anything about the supply side. How confident are you in their ability to get it down towards their target without a hard landing?
Not very confident if this is their current strategy. So we're reevaluating our forecasts now, and there is a very significant weak patch in most economic models between Q1 and Q3 of 2023. Whether or not it tips the scales into mathematical recession depends what you're looking at. But the real story is this is a material growth slowdown. And guess what? Whether it's recession or not recession, that's not the name of the game here. That's an overly binary type of focus.
Francis, thanks so much. We've got somebody who cares less about us than your mother-in-law, and that's Qantas. Emailing in the evening of Perth in Western Australia. I believe it's Western Australia, 12 hours behind. It's good evening to Qantas in Australia. And he notes that a kilometer, Lisa, I mean, I never get it right. 1 kilometer equals like 0.6 of a mile.
You're not going to quote that to 17 decimal points. I mean, this is where's the Tom that I know? Yeah. I mean, normally you would go all the way out.
It was like 600 digits of pi.
I know, right? Like I have that.
Because we're nailing Western Australia here, Lisa. Let's talk about commodities. They are part of this pullback. It's a growth slowdown. Copper south this morning.
Right now, when you look at the jump conditions, I'm going to channel a Tom Keene. If you look at the jump conditions, they are there in terms of how quickly things are moving in the commodity space. And it's led Citigroup to come out and said this really is akin to what we saw in the 1970s, particularly with oil and gas, when it comes to the proportion of GDP and the increase that we have seen year over year. That, again, is factoring into these feelings. Perhaps it's not the same as 1970s, but it's starting to rhyme a little bit.
Yeah, Kaylee, one of the differences here, and I don't want to be inflammatory here, is because corn is nowhere near $8 a bushel. But I'm looking at the rice, corn, wheat complex on my screen. I'm looking in Australia at Newcastle coal, which is, I think it's in Queensland, like
someone get Tom
crocodiles. I don't even know. But to be honest, Newcastle coal in Australia has not pulled back. And Kaylee, I think that really speaks to the tension here of a China opening versus all this other financial gloom.
Big time, because right now, obviously, China's still firm in its COVID zero policy. You saw over the weekend some of those restrictions being put back into place. But there are now commodity strategists out there saying, be prepared when China opens back up, because that is going to unleash even more pent-up demand, and there isn't going to be the supply to meet it. So that would just exacerbate the higher prices we are seeing in commodities really across the board. And that all comes down to food and energy, basic necessities that people have no choice but to pay up for. And if they're paying up for that, when do we start to see real demand destruction for other things?
Some guy in a bar called Platypus in New South Wales emails in and goes, Tom, you moron. Newcastle coal is New South. I don't even know where New South Wales is.
I know, that's why Kaylee recommended that you get a better Wikipedia.
It's north of Tasmania. I know that. Okay.
You're killing it, Tom.
Let's go back to a data check. Lisa, help me out here. It's a little better tape off the carnage of an hour ago. We were up 5 on VIX. We're now up 4.87. Negative 91 on SPX is negative 88. I'm struggling here, Lisa. Help me out.
You say a little bit better. A little being the operative word. I'm looking at the Nasdaq futures, and I keep watching Nasdaq because for a while people were saying you're starting to see some traders cycle back into big tech as some sort of haven of cash flow. It's not happening, right? I mean, it's down right now at 2.8%. And again, the underperformance of the Nasdaq versus the S&P is something we have not seen to this degree more than 10 percentage points at this point, or about 10 percentage points going back to the early 2000s, to the dot-com bubble. How much more do we have to go in terms of repricing if the Fed were to really act in a massive way? This, to me, is shocking because this has been the bedrock of so many portfolios, right? What proportion of the overall index, some crazy amount, are these stocks, Tom? It's a big deal.
And the yields are moving as well. Let's do a Ferro data check here on German yields. 1.1% on the German 2-year. And, of course, that vaults out to the Italian 10-year at 4%. which is sort of the bond roulette wheel of Europe. Really interesting right now. And again, dollar strength this morning. Stay with us with more data checks through this market turmoil. Futures at negative 88. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The UK economy shrank in April at the sharpest pace in more than a year as the government reduced its COVID-19 testing. That is pointing to risks that a broader contraction is underway. Gross domestic product fell 3% from March when output declined 0.1%, according to the Office for National Statistics. And China is starting to reimpose those COVID-19 restrictions just weeks after a major easing in key cities. The actions is raising concern the country may once again employ strict lockdowns to control its outbreak. Beijing reported 45 new local cases in Monday after having single-digit cases on most days last week. The yen fell to a 24-year low and Japanese bonds tumbled Monday, prompting a warning from the Bank of Japan. Rising global interest rates are seen to be an issue there. The currency fell more than 0.5%, the lowest since October 1998. The yen has tumbled almost 15% this year. It is the worst performing of the major currencies. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes. But Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential election from his result 5 years ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
China changed the picture in the sense that we have a much longer lasting and persistent inflation than we would have had in the past. The supply chains are completely broken. It looks like, given the zero tolerance policies that President Xi has put in place in China, it's unlikely the supply chain is going to come back anytime soon.
He was absolutely brilliant. I believe it was Friday or Thursday last week. William Lee, of course, with all of his Pacific Rim work for the IMF, and now with Michael Milken at the Milken Institute. I thought Dr. Lee was just brilliant on the challenges of the Pacific Rim centered around COVID, which is something we've not talked about with the miracle of vaccines in America. We're going to give you more market checks here. The negative 91 SPX is now negative 87. A little bit of a quiet in the carnage overnight as well. Let's do that. On radio right now, we're featuring oil a little bit south. We did have curve inversion momentarily, 4 basis points rather, on the difference in yield between the 10-year and the 2-year. The difference in COVID reality in China is real. I know Elisa and Kaylee want to talk about China and the markets, but I've got to start with a single headline in the Blur this morning of Beijing and real doubt about COVID. What is the Bloomberg reporting on COVID and the ability to restart a broken China economy?
It seems to be a backward step, Tom, happening up in Beijing and Shanghai at the moment. So we had been saying that restrictions were eased in recent days, eased quite quickly actually. But over the weekend, we get news of another tick up in cases in both Beijing and Shanghai, 50 odd in Beijing, a lot of which is linked to a single bar, by the way. So they've kept schools closed up there, and they're implementing another mass testing campaign in some parts of Beijing. And of course, in Shanghai, similar kind of story, new restrictions around dining in, for example, being reintroduced. This was only after the city opened up, or has reopened after that bruising 2-month lockdown. And I think a lot of people today looking at this news over the weekend are really saying this just goes to show you how challenging COVID zero is going to be for China in the weeks and months ahead, because we all know the backstory with Omicron and how transmissible it is. But people are asking, how long can this go on, and how can China get that balance right between the economy and of course trying to contain the virus. So I think big question marks now, Tom, remaining over China's whole COVID strategy.
And China is kind of at the core of how bifurcated the world economy is right now. On one hand, prolonged shutdowns are going to slow the economy for lack of demand, lack of production. On the other hand, it could help the commodity picture. Is that really the way that we should be looking at this? If they reopen, that could be yet another shock, as Kaylee was saying, in terms of commodity demand.
Yeah, well, Lisa, you're right. People make this point, of course, that if China's factories are offline, then surely that will have knock-on consequences for energy consumption and, of course, buying bulk commodities like copper and iron ore, etc. There are different ways of looking at it, of course. We have actually seen a fairly quick rebound in China's factories and China's exports over recent weeks as the reopening gets underway. But the bigger issue that might be coming into play for the manufacturing story in China is actually slowing global demand. I mean, we hear from manufacturers a lot. We've spoken to factories in recent weeks, and they're all saying that their order books are actually slowing down. So forget the supply side story for a moment. They're saying their end demand is weaker in Europe and the US. So if their order book is weakening, that speaks to less activity. And then to your point, that could speak to a source of disinflation for the global economy. And plenty of economists are saying China could become just that this year, a source of disinflation rather than what it was last year, a source of inflation.
So, and at this point, with the shutdowns, the rolling shutdowns, and the feeling that at least ahead of that Party Congress meeting later this year, we're not going to see an end to zero COVID, that China is probably going to grow sub 4% on a GDP basis, and that the rest of the world is not necessarily increasing demand to offset that.
This seems to be the worry now facing China. So you've got two issues going on, Lisa, like you say. You've got the underground domestic problems, and the domestic problems are, let's not forget, the housing slump as well. That's still a big drag on China's economy. The workout in the housing sector, that's up to maybe 25% of GDP, so that's happening. And you've got the ongoing disruption from COVID zero, which is having a clear knock-on both consumer confidence, how can people go about their daily lives when they are concerned about the restrictions coming at any moment, and like the factory side of things we've just spoken about. But then you've got the external story, and the external story is that China's great export and trade boom might be coming off the boil, and that was a key dynamo for China's recovery during the pandemic. I mean, we saw bumper trade numbers coming out of China. That's expected to come off the boil now. And by the way, that's expected to see even more of a decline as we head into later in the year when interest rates hikes around the world really do start to bite on household disposable income in the US and Europe. So I would say China is facing dual pressures now. Domestically driven ones, given their approach on COVID and what's happening in housing, and as you mentioned, slowing global demand.
Well, and on the subject of external things that China is dealing with, or at least are part of the China story, and what is your take on the developments over the weekend, the conversation between the defense minister of China and the defense minister or defense secretary of the U.S., and the conversation around Taiwan feels like it's escalating in quite dramatic fashion?
Well, you have to take it on face value. It's obviously very hawkish rhetoric, Kylie. It obviously demonstrates just how sensitive the issue of Taiwan is now between China and the US. I mean, you heard those comments from the Chinese defense official at the talks in Singapore. I think a lot of people also, by the way, are taking away from it that it's the context of this conversation, despite what's going on in Ukraine with the Russian invasion of Ukraine. There was a thinking that maybe perhaps China might mellow some of its language, might soften some of its tone, look for a meeting of ways, as China has in the past. But I think a lot of people today, their big takeaway from that was that there was no softening of that tone. Very hawkish when it comes to Taiwan. I would say, though, it's important to say there was also a message from China in that same speech that they are still looking to engage on the international stage. They do believe in that multilateral world order. So there were two messages, I would have to say, in that speech.
And thank you so much for the report from Hong Kong. And to Curran, of course, with Bloomberg News. I want to walk through the data check there. Lisa, help me here. Futures negative 91, now negative 83, a little better support. The VIX is a 5-point X level, comes into 4, up 4.7, 4 points, 32.49. Lisa, I know you're watching NASDAQ percent as well, but the answer is it's a pretty even application of percent change in equities.
Yeah, and that's what what you're seeing right now. Wholesale risk off, and this is really driven by the bond complex. 2-year yields edging away from some of the highs.
13 basis points.
But honestly, just such a huge move to the highest levels that we have seen since December 2007, 3.19% on the 2-year, on the 10-year, 3.23%. And if you take a look at that yield curve, we've avoided inversion, but Tom, it's getting really close, and it is dollar strength across the board. And how many notes did you read over the weekend, Tom, talking about how there's nothing to really stop it? I mean, at this point, given how much the Fed has to do and given that they have not blinked yet, how do they really avoid dollar strength in the face of global stagflation?
And of course, the basket case of the moment, is outlined by OECD, is the United Kingdom. I believe they have a banking meeting this week. John Ferro scheduled to be in attendance. And Lisa, moments ago, I had a 1.2200. We're going to get a 121 handle on sterling. This is a 14% drawdown, or 14% sterling depreciation off of the peak of another time and place.
And it highlights the angst of the moment for central banks, hiking rates into weakness. At what point does the weakness call their hand and make them think again?
Gold showing that growth scare, -15 on gold, 18.61 an ounce, and Euro Swissy a 103 handle. Stay with us with futures at -84. This is Bloomberg on radio and television.
Fed has got to regain its credibility that it is serious about inflation fighting.
We're dealing with a little bit of a stagflationary environment here.
I think it's important to realize that we got a lot of emotion here in this market.
Investors, they've become very accustomed to good returns, low volatility, and always being supported by the Fed.
This economy is not falling off a cliff today, and actually is quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. An extraordinary Monday. Kaylee Lyons in for John Ferro, which is a good and beautiful thing. And we show you futures at -91, a little bit of an improvement, -84. That's not Dow futures. That's Standard & Poor's futures -2.1%. Dow futures -535. I guess it's a little bit to the tape, but don't tell pound sterling, Lisa.
No, and there's definitely a lot of weakness there. What we are looking at is a full-scale concern about how quickly inflation is taking off, that it is broadening, that it is becoming more protracted in people's psyches. And we are looking at the possibility of a 75 basis point rate hike as soon as July, if you take a look at where markets are pricing it, Tom.
And it's a sequence of the rate hikes and embedding it in, and the terminal rate comes up. We'll speak to Julian Emanuel about that in a moment. We're going to get through this quick. Kaylee, give me one insight on what you've seen in your reading from Sunday.
Well, basically, the only thing that you're safe to buy in this environment right now, Tom, is the dollar, because your 60-40 portfolio, not going to do it. Worst quarter for the 60-40 since 2008.
Oh, don't get me going here. She knows how to get me going. Yen 134.49, Euro 104.66, and that strong dollar. Kaylee mentions EM showing all the stresses, even Mexico out 2% this morning. The 2-10 spread, we did have brief inversion there for a moment. Right now, 4 basis points. Let's call it a flat curve to be ecumenical. The 10-year real yield, 0.45%, is a higher real yield. And the yield backdrop from the 4% Italian piece out to the German 2-year up 1.1%. The U.S. 2-year 13 basis points, a 3.19% is a market adjusting to the Fed lift we may see. And we would mention also before Lisa's brief, Bitcoin, Southie feel this morning. It's Lisa, I was going to buy at 55,000 and you saved me.
All right. Well, maybe you can lever this one up and
what do you see, Lisa?
Going forward, we are looking not just at today, because today, not a lot on the table except for the market action. This week, massive. Wednesday, we get the FOMC rate decision, 2 p.m. Fed Chair Jay Powell speaking at 2:30. This comes as 2-year yields bake in that longer and steeper rate hiking path. Yields now exceeding 3%, 3.2%. Will they confirm that? Thursday, we get the Bank of England rate decision. This is the conundrum of the moment. How do you hike into to weakness. And that is what's facing UK as they see two-year yields climb, but longer-term expectations for growth shrink. And Friday, we get the Bank of Japan policy decision, key for a market that's not a market, at least when you look at bonds. In the FX world, very much a market, and the market is signaling record weakness, at least going back to 1998 with the yen weakening versus the dollar the most since 1998, Tom.
135 through that would really be something. We're getting through this quickly this morning. Again, futures at negative 83, doing a little bit better because we're blowing up the show to give you the best of market coverage. We're thrilled to tell you with our important research note Friday and into the weekend, Lori Kelvicina of RBC will join us later on Surveillance this morning. She makes real clear there's a growth delay. She's optimistic, but she has a growth delay from value to growth. Now, working with Edward Hyman over at Evercore ISI, Julian Emanuel joins us now, their chief equity and quantitative strategist. You have such a privilege to work with the Evercore ISI team and dovetail the micro-analysis of Ed Hyman into your equity work. And the heart of it is inflation comes down, but it only gets down in the vicinity of 4%. That's a change.
Right. That is a change. That is an acknowledgement that basically what we saw last week says, well, there may be a peak somewhere in here because mathematically, if you get to nothing but base effects, you probably get a peak, but it is likely to be a higher plateau for longer. And Ed took his inflation number for 2023 up to 4%, and that's the issue. That's where the Fed has much less wiggle room than we would potentially like, given the stress that we're seeing on asset prices.
Since his days as C.J. Lawrence, we've all watched the white paper with the black marker. He got the black marker on one of my shirts once. He had to buy me a new shirt. It was a stupid black mark. Tom, I'm sorry, Tom, I got you. Is the black marker calling for a recession right now?
I've been nailed with the yellow highlighter the last couple of weeks. No, Ed took his growth number down to 1.4% for 2022 a long time ago. He saw these headwinds. We still think the base case is no recession, but obviously, again, the same math that applies to the potential peaking of inflation also tells you that 1.4% to what could be a recessionary number, there's not a lot of distance there.
Julian, when does your bear case become your base case of 2,900 in the S&P?
Well, all I can say is when we spoke about this last week, we certainly didn't envision 3 days of carnage in the markets that we've seen since we adopted that much more cautious view. And frankly, when you think about it from a trading perspective, what's been missing the entire last several months is sort of what I would call a cathartic flush out, where you get the VIX above 40, which is one of the things you need for at least a trading bottom. This week is fraught with peril. I got like 8 questions, but Lisa's here. Folks, I just want to, in the carnage that we've got here and the more data checks, we need to point out that it is the Bramo base case, bear case that we're talking about.
Yeah, well, this week is fraught with peril, Julian. I mean, I couldn't say it better than myself. Going forward, then, how do you determine if we've hit catharsis? Just that 40 level on the VIX, or is there something more? Is there some sort of forced selling, a disorderly unwind that we have yet to see, despite all of the pain?
So what we are likely to see, regardless of whether the markets decisively take out the May 20th low, which looks like is a distinct possibility today, certainly into Wednesday, is you're going to have an enormous amount of volume at mid-month and the end of the month. Quadruple witching, the Russell index rebalance. We'd love to see that kind of volume, 20 billion shares, perhaps 25 billion shares on a day, along with the VIX surging towards those levels. Those are the kinds of recipes for a catharsis that we think you need really to entice buyers back. And the last several weeks has not been about selling overwhelming. It's been about a complete lack of buying.
Well, and yet the case remains, Julian, that we've already seen this immense selling pressure. And even before today, the S&P 500 has already teetered on the edge of bear market territory. You already have a 10-year yield that is at 324. And we've only just seen the start of quantitative tightening. It only really has just begun because, of course, these markets are anticipatory. They're forward-looking. How long is it going to be until this market is looking even further out and saying, well, the Fed's going to actually have to pump on the brakes here a little bit and we start to see things reversing?
Well, that is a question that watching the bond market, and one of our core theses around the view that 2022 was going to be volatile, before Russia invaded Ukraine, was the fact that the correlation between stocks and bonds in a higher inflation environment was flipping from risk on, risk off that's been 25 years long to a positive correlation. We will be looking for the 10-year yield, the ascent in the 10-year yield to start to moderate a little bit. It wouldn't be a surprise if we get towards 3.5 in the near term to start to see some buyers come into bonds. That would stabilize stocks.
Okay, so maybe there's going to be eventually an entry point to buy the dip into bonds. Or do you see any entry points at this time in the equity market, anywhere that valuations have come in enough that it actually is safe to dip your toe back in yet?
I think there are pockets of value, pockets of stocks that have been proven, still growing earnings in this environment, and that are returning cash. Remember, in an environment where we are focused on return of capital, companies that can return capital successfully are names you want to own.
Are they going to return cost cutting? Because if we get an Ed Hyman 4% stability in inflation, I'm a corporation, I have to adjust.
You do, and part of the dynamic here that's causing this incremental market pricing closer to recession being a base case is the fact that all of these factors together is going to cause pressure in the labor market, which paradoxically, again, the Fed would wish to see a little bit of that, but the difference between softish and something else is very fine.
Julian Emanuel, thank you so much with Evercore ISI. Lisa, I don't know where to begin on a data check here other than to say the tape's better than an hour, maybe 90 minutes ago as well. In the currency space, Lisa, there's just continued dollar advance. And sterling, I don't want to use a word like plunge, but there's just not a bid on sterling. We went from 1.2200 to 1.2182 rapidly.
So the United Kingdom is unique among the developed world because they report monthly GDP growth statistics. And this has been the second monthly negative print for the GDP in the United Kingdom. And a lot of it does have to do with them ending free COVID testing because that program gave some funding to the economy. But the fact that that was the difference highlights how much weakness there is. And all of the multi-prongs of the economy are slowing down. Tom, how do central banks deal with weakness? How do they signal that they will be more dovish, that they will pause in the face of weakness when the weakness is being driven by inflation, which they have to control by raising rates? This is the conundrum of 2022.
The conundrum to me is, as Julian Emanuel said, Lisa, the partition of inflation. Part of it is going to go away rapidly and you come down, but an Ed Hyman 4% inflation is flat out unacceptable to any central bank.
You look at projections saying even if gas prices don't climb from here, if they just stay where they are, that's going to be a big problem. But that's exactly right. That is exactly the conversation because they are moving quickly. Even that will create a real problem for consumer sentiment.
All she cares about is a gallon of gas.
No, that's all a lot of people care about. I can handle, a lot of people can't even handle this.
There we
budgets.
go. There's
so
the Brahma we love. Negative 559 on the Dow. Stay with us on radio and television. This is Bloomberg.
With the first word, I'm Ritika Gupta. Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. Russia continued its assault on Ukraine's Luhansk region, pushing Ukrainian troops out of the center in what is Kyiv's last foothold in the area. President Volodymyr Zelensky, in his nightly address, called fighting over a main city there very fierce. Russia's use of cluster munitions and indiscriminate shelling in Kharkiv. The UK's financial regulator has added Credit Suisse to a watch list over concerns it hasn't sufficiently addressed risky culture. The lender has struggled to draw a line under a series of scandals. The Financial Conduct Authority told Credit Suisse last month it was adding the bank's UK operations and international unit to a list of firms warranting close monitoring. The software engineers on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the project. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he's breached the firm's confidentiality policy. And Top Gun Maverick has had its box office crown stolen. Jurassic World Dominion, the sixth film in the franchise about dinosaurs that escape from an amusement park, fought off weak reviews to lead the North American box office, topping Top Gun. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
It's pretty clear that peak inflation theory, like transitory inflation theory, is kind of wrong. The Fed's forecast from March saying that inflation would be coming down to the twos by the end of the year was frankly delusional when issued.
We're going to stop the show right here. That is Lawrence Summers, a former U.S. Secretary, Harvard president, and really, really interesting economist. It is the call of this crisis. There's no question about that. And what's so important, Lisa, to me, Lisa and Kaylee Line's with us today, John Farrow's off, is his seminal work as a kid with a guy named Olivier Blanchard.
As a kid.
And the backdrop of Summers is a thing called hysteresis, which is if you have a slowdown in an economy, what does it do to employment trends? We're not there yet, are we? I mean, one of the great distinctions here is we're supposedly fully employed.
This is the concern. Where does employment have to go?
Right.
Where does unemployment have to go in order to get inflation down? And you know, Larry Summers has been on top of this. He warned early that this inflation wave would be much higher and faster than people expected, and he was right. So his concerns are actually worth
Right.
heeding and somewhat more alarming.
I'd love to talk to him now for an extended conversation. It would be great. Here's what we know. President Biden is doing his part, jetting around the country on Air Force One to make, well, fuel demand go up. It's 63,500 gallons of fuel to make Air Force One go. Joe Matthew can do that math and joins us from Washington right now. Joe, not to be snarky, but it's Snark Monday. What's the president's plan this week to tame gasoline and inflation?
Well, book a trip to Saudi Arabia is what we're hearing. The White House has not confirmed that trip, but the president kind of did over the weekend when he was asked. He said, I'm not confirming that yet, but I'm going because of reasons other than energy. So he's going to pop up there at some point here. And boy, it says a lot about what we've been through over the last year with regard to energy prices, to see the president going to a nation that he called a pariah of the world here to try to unlock more supply. But he's going to do a little bit more than that. He's actually booking a trip to Philadelphia tomorrow as well. AFL-CIO. He's going to talk about the working economy. They really do want to point to this strong job market that you're just referring to as maybe the other side of the story from inflation here, because the messaging is not looking great. As you heard from Larry Summers, this is a White House looking back on some decisions that were made coming out of COVID. And I do wonder, Tom, if Larry Summers was in this White House the way he was during the Obama White House, and he said, look, that's too much money. You're going to create too much inflation in the COVID stimulus. I wonder if it would have actually changed the final price tag on that, because, look, people felt like they were in a desperate position and had to do something.
That's called the counterfactual Matthew, Lisa. He does that with the Red Sox in late August.
We could look backwards, but really what we need to do right now is to look forward and what Joe Biden can actually, and what he will attempt to do to bring down inflation. Parsing beneath the hood, it's not just gas prices, right? I mean, this is obviously a multifaceted issue having to do with rent and a whole host of other things. However, he has talked about gas, saying that Exxon is making more money than God. Look at their profits. Are we looking at some sort of windfall tax in Washington, D.C., akin to what we saw over the United Kingdom?
can't imagine that there would be much appetite for that on Capitol Hill right now. The president is in a messaging war. If you can't do a lot about it, the best you can do sometimes is talk about it. And the White House has been adamant about the fact that this is a global phenomenon, that this is not an American experience here. It's something that's being felt around the world. Interesting, though, when you consider the president's language most recently has been all about Vladimir Putin. We haven't even heard about COVID so much lately. It's the Putin price hike. He said it again at the Port of LA at the end of last week. The same time he called out ExxonMobil. But we have to remember, this White House is supposedly engaging with companies like Exxon right now. So it speaks to the relationship that President Biden has with oil companies when he's calling them out publicly, but also asking for help privately in terms of greater production.
Yeah, he wants them to pump more. And he also, other than Putin's price hike, continually comes back to the talking point of there still being thousands of wells that the oil companies aren't utilizing. The idea that they could produce more if they wanted to, they just aren't doing it. But Joe, as you say, he's trying to fight a messaging war here. This is something he has been trying to do for months now, and the clock is ticking. We are less than 5 months away from the midterms. I mean, how much longer does the president realistically have before the fate of November is sealed?
Well, a lot of people would tell you, Kaylee, it's already sealed, and it was before even the war in Ukraine based on historical factors. And by the way, the inflation that existed long before Vladimir Putin ever went into Ukraine. But this White House doesn't have a lot of options right now, aside from messaging. I do think that most of us overplay the idea of the impact that the president of the United States, that even Washington as a whole, can have over the economy and inflation. This thing is off and running. And in many cases, the economists in our capital are watching it from the sidelines, just like we are.
Joe, we've asked 4 weeks straight here, I believe it is. It may even be 5 weeks as well. The New York Times with a splash this weekend about a one-term Biden. When does he clean out the White House just to reinvigorate the White House?
That's a real good question. It's one that we're asking a lot about. Of course, we saw Jen Psaki go away not that long ago, and that's pretty common for a press secretary. But I suspect that once we get through November, Tom, once we get through the midterms and all the messaging and the posturing going into Election Day, you're going to see quite a number of people going through that revolving door.
Joe Matthew, thank you so much. What we do here, and again, futures negative 93, reversing back down. The Dow futures a little better. The VIX out 4.95 points. Lisa, there's research that just comes in on an incredible Monday like this and through the weekend. And Carl Weinberg of High Frequency Economics with a tour de force on China. It's 2, 3, 4 pages long. I'm not going to go into the details, but he is heated. Their numbers are baloney. He says simply, where are lockdowns in the data?
And frankly, a lot of people would agree with him. Everyone's been saying if the official figure is something like 5%, you can look sub 4% in terms of GDP growth in China. And that's what the granular data is showing with China Beige Book. How does that bleed out into what we see globally in terms of a global growth perspective? Who's going to be the driver of growth at a moment when China's bowing out, India's bowing out, emerging markets are challenged? Where is the marginal growth?
And Kaylee, to what we heard from Enda Curran, the idea of, it's supply this, supply that, but maybe it's just a diminished global demand which slips in here in the summer months.
Well, and you saw that reflected to a certain extent in the inflation data we got out of China last week, the idea that people aren't buying as many goods because of the impact of inflation. And we're, of course, seeing that rotation into services. So that does help on the demand front. But also speaking of demand front, if China is able to open back up, if they figure out the COVID zero policy, that also has ripple effects globally in terms of commodities prices, because there still is going to be the lack of supply that the rest of the world is already dealing with. And China being offline actually helps that narrative.
Data check right now. Lisa, help me out. Sterling weakening now 121.78 as well. But Lisa, the tape again tips down. SPX futures negative 92. And Lisa, Bitcoin flat out can't find a bid, 23.
And frankly, right now, I got to say, one of our guests, I won't reveal who, said ahead of this market open, they were nervous. They are nervous because this feels fragile, and this is all being driven by rates.
But is it Abramo nervous? There's levels of nervous.
Neurotic. What do you expect?
Stay with us. morning, everyone. Bloomberg surveillance, an extraordinary market. Let me get right to the data check here. Lisa Abramowicz and Kaylee Lyons with us this morning. Futures negative 92, now negative 88. They're a little bit off the bottom, but I really don't want to sell that to you. It's a churn, is how I'd put it here, with the VIX rounded up to 5.5 handles, 32.71. We heard Julian Emmanuel of Evercore ISI make clear they're looking for catharsis at a 40 level, not at the 30 level. And I think Dean Kernett, expert on that, would agree with that assessment. That yield 3.20%, a 14 basis move higher in the 2-year yield. If that's Greek to you, all you need to know is yields are surging, which I believe is prices going down. Lisa will correct me if I'm wrong on that. Oil, commodities showing a weaker growth here. Copper off, oil off 120, down from the 123 level on Brent crude. And obviously a dollar bid as well. You don't care. You want individual names. Kaylee Lyons assists. Kaylee.
Well, and of course, there are a few individual names that are more important than the tech mega caps, Tom. And we are seeing all of those under pressure in early hours this morning as this market is very worried about an aggressive Federal Reserve and higher rates to come. That's put pressure on higher multiple companies. So you have Apple down 2.9%, Amazon down more than 4%, Microsoft down 2.5%. Just these three names together comprise 15% of the S&P 500 and more than 28% of the Nasdaq 100. So if these stocks can't hold in there, it is very, very difficult for the broader market to hang in there. And of course, one asset class that's definitely not hanging in there today is cryptocurrencies. Bitcoin is back below $24,000. Tom, you can make fun of me all you want, but this is very real. This is serious.
What is MicroStrategy? Wait, stop the show. Explain, Kaylee, what nobody knows that name.
Michael Saylor.
What is MicroStrategy?
It is a company that is essentially a Bitcoin proxy stock because it continually adds to Bitcoin to its balance sheet. So it is essentially trades in tandem with the cryptocurrency. Michael Saylor, of course, is a big time crypto evangelist, Tom, but it is taking it on the absolute chin this morning. It's down 25% in pre-market trading. These are monster moves, and it's not just MicroStrategy, of course. It's basically any equity that is tied to cryptocurrencies in some form. Marathon Digital down 17%, and Coinbase, which of course is the big crypto exchange, it's laying people off. It's really dealing not so great with this broader macro environment. Coinbase down 15% before the bell, Tom.
Very good. Mike Wilson of Morgan Stanley out with an important research note, and I just really want to parse that his distinction is corporate confidence and the idea of will they conserve cash or continue use of cash share buybacks. We'll talk more about that here in a bit. Right now, we have demanded she attend today. Deborah Cunningham is with us. And what she is expert on the wicked, this is a Boston phrase, even though Federated Hermes is from Pittsburgh, a wicked short-term market. Deborah Cunningham, you are focused on not the 2-year yield, but the courage and fear to move inside of 1 year. What's happening in the 12-month or lower space?
Well, first of all, we have offices in Boston, so I'm wicked understanding the phrase. As far as the 1 year space goes, I mean, 1 year and under, you're looking at preservation of principal. If you're even in the 2 year, you're worried still about big breakouts from a pricing standpoint to the low side simply because of the rising rate environment and not having enough income yet to cover that difference. On the 1 year and under space, you don't have to worry about that preservation of principal. That's pretty much a stable value product that you're looking at. And so your return is basically what your income is generating. And that income is not huge yet, but it's continuing to go up. And you can believe June and July, it's going to go up by another 100 basis points.
Deborah, to give us a mood, to give us a feeling of the retail investor, do you see flows right now into cash accelerating in a way that is not familiar over the past 10 years?
Well, you know, the retail investor moves fairly slowly. So it's not in any kind of a huge wave or a huge force that we're seeing that yet. It's more what I'd call a trend, an operating trend that's going from the more riskier asset classes into those that are a little bit less risky, which ultimately would be the cash market, the cash asset class. So not waves, but more like, trends that are heading in that direction.
Deborah, you're at the moment, you're at the heart of a lot of what people are worried about, which is liquidity problems, which is as the Fed raises rates and as the Fed withdraws liquidity, that you're going to see disruptions in some of the most safe markets, including the cash markets. Have you seen any signs of dysfunction in that market?
We haven't really seen that yet at this point. What we've seen is a lot of demand. So lots of people coming into the market, retail as well as institutional, and good supply. Good supply outside of the Treasury market. Treasuries have been low in supply because effectively bills have been being cut since tax dates back in April, and they continue to be in low supply, but with a high demand. That's why you see lower yields on the short-term Treasury bill marketplace. But when you go into credit markets, commercial paper, CDs, other types of short-term notes, they're in good supply with good liquidity and good demand at this point.
Well, but Deborah, as Lisa talks about the Fed sucking liquidity out of the market, that process has only just begun. Quantitative tightening is barely underway yet. What can we expect to unfold over the coming months as that happens in more substantial fashion, considering how far this market has already moved just in anticipation of it?
Well, as I said, Treasuries are in short supply. So to get Treasuries back into the marketplace would be a great thing. That would actually add to liquidity. From an MBS standpoint and longer-term Treasury market standpoint, you've seen the RRP, the Fed's reverse repo facility, trading, at over $2 trillion on a quantity basis for the last 2 or 3 trading sessions. And if you end up with more collateral for what I'll call the traditional repo counterparts in the marketplace, maybe that starts to bring that RRP back down a little bit and back into what would be sort of more normal supply, with the traditional counterparts of banks and broker dealers having the supply that's coming from the quantitative tightening for the Fed. So I don't see it as being a huge problem unless all of a sudden investors turn away from the cash market. We don't see that happening anytime soon.
Okay, so what kind of cracks would you be looking for? Where do you think the first thing might break if the Fed is too aggressive?
Well, I think you want to look for a lack of demand when there is all of a sudden a huge spike in pricing that's not due to inflation, that's not due to an outlook from a standpoint of normalization turning into tightening, but rather due to what I'd say would be more credit concerns. Everything we've seen so far seems to stem true from supply-demand issues, from issues from, a supply chain imbalance, the Russia-Ukraine conflict, lots of things that are contributing to it. When you start to see maybe some credit imbalances, that would be a true sign of a problem.
Deborah, thank you so much for the brief. Really appreciate it. With Federated Hermes there on Inside of 12 Months paper. This is what we're doing today, folks. We're moving around between, I forgot my glasses. Somebody said, Tom, where are the glasses? We can't have a morning. I have my Tang, but I left my glasses at home. I'm sorry. Vet bill hit them. Okay, let's move on. I want to talk, Lisa, about what I think is not being talked about, which is the greatest bear market in bonds in my lifetime. Let's go away from what the media quotes, which is full faith and credit, and look at the world of Lisa Abramowicz. She is expert at IG. And I'm sorry, Lisa, it's a minus 15%. I just looked at a GM 10-year piece down 19%.
It's shocking. It's things that we've never seen before in this space. And the fact that we have not seen wholesale exodus from some of these portfolios is notable, and actually starting to see some money come back. Here is the issue, is that at its core, we have not seen corporates break down. The corporate fundamentals are still pretty good. So at what point do people start selling off that as well, or does that become a haven? The bigger issue for me is that the S&P is on the brink of a bear market. We are 2 percentage points away. If the moves that we're seeing pre-market hold, we are in a bear market for the S&P. Credit has not broken down in the same way. This is the reason why people think that the Federal Reserve will not step in. If you don't have that credit impulse breaking down, if companies don't need to refinance, which is the issue, then what is going to cause the Fed to say, oh my goodness, we need to back away? Nothing. And that is the reason why people are getting so bearish on stocks, even more so than credit, Tom.
Yeah, and if we can get this up, great. If we can't do it, it's fine. But Kaylee, I featured it at 5 a.m., which is over on the equity side, and the implied volatility of the Standard & Poor's 500, the VIX, where we're above 30, and everyone waking up today, even the non-sophisticated, say we're above 30, but we're not above 40. And the answer is the VIX. Yeah, it's elevated, but it's, as Lisa says, it's not that catharsis this morning.
That's the thing, Tom, is the selling is still so orderly looking. We haven't seen that volatility blowout where it seems that everyone is capitulating. Everyone is just forced to sell. It hasn't happened yet. So the question is, when is that coming? And is that the only point at which people can get a little bit more optimistic and say that the bottom may be in equities? As Lisa says, we could enter a bear market today. How much lower can it go after that?
Well, we're going to have to see as well. Lisa, what does this do to issuance? I mean, I make jokes about the auction, but what do chief financial officers do when they see bonds lower, yield higher?
Well, they definitely don't issue bonds opportunistically unless they see things getting even worse down the line. They don't issue, right? I mean, you're seeing things slow down, or else they issue to get ahead of whatever may happen. But then occasionally when they do issue, they offer yields that are so attractive that everybody comes in and it's a food fight. And that's what we saw with Carnival. They actually issued bonds a couple of weeks ago at this incredible coupon, and everybody flooded in because you're finally getting yield, Tom. I mean, honestly, people have been yield starved for years. This is actually really attractive for the likes of Howard Marks suddenly.
Yeah, John from Marina Piccola on Capri emails in.
You're sending him to Korea now?
Yeah, no, he's in Capri. And
which, north or south?
Says, you got to quote the German 10-year more, 1.60%, out 7 basis points on German 10-year. Stay with us on radio, on television. We will do more data checks. Futures at -91.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The UK economy shrank in April at the sharpest pace in more than a year as the government reduced its COVID-19 testing. That is pointing to risks that a broader contraction is underway. Gross domestic product fell some 3% from March when output declined 0.1%, according to the National Statistics Office. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes, but Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential election from his result 5 years ago. And China is starting to reimpose those COVID-19 restrictions just weeks after a major easing in key cities. The action is raising concern the country may once again employ strict lockdowns to control its outbreak. Beijing reported 45 new local cases on Monday after having single-digit cases on most days last week. And iron ore plunged on Monday after China enacted those COVID-19 measures in major cities, which fueled worries about demand. The steel-making material fell more than 5% in Singapore for its steepest drop in close to a month amid thin trading. Beijing has been warning about its struggle to contain a fresh outbreak. And the yen fell to a 24-year low, and Japanese bonds tumbled Monday, prompting a warning from the Bank of Japan. Rising global interest rates are seen to be an issue there. The currency fell more than 5.5%, the lowest since October 1998. The yen has tumbled almost 15% this year. It is the worst performing major currency. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think that we're in a recession now, and I don't see a recession this year. I think the recession will come after the Fed gets itself into a restrictive monetary posture, and that's going to take some time.
Michael Darda, absolutely brilliant. I believe that was on Friday with MKM Partners here, really looking at this focus on nominal GDP and how it slides down. We're going to talk to Gina Martin-Adams about that in a moment, the animal spirit of a turmoiled American economy. I've got Kriti Gupta in a moment, but let me do the data right now. Lisa, help me out here. It's simple. Standard & Poor's 500 futures, -94. They roll over near lows for the day.
Yeah, deterioration across the board, and this really is being driven by rate hiking expectations. How much did Friday's CPI print change the narrative with widespread inflation continuing to exceed and peak inflation not being peak?
But as we talked about at the top, to me it was inflation expectations and a reset of where the terminal value is out there. And again, I go back to Julian Emmanuel, which is getting inflation down to 4%. So hope, but the dream is to drive it lower.
Yeah, and we're not getting there any closer to that.
Well, there we are, and we'll give you more data here with dollar strength right now. Sterling 121.77 is at a uniquely ugly morning. On financial conditions, Kriti Gupta.
Yeah, Tom, we have to talk about the combination of all the moves, not just the stock market drop, not just the drop in treasuries and yields higher, of course, price lower, but also that dollar strength that you were just talking about. Combine all of those together with a little bit of credit spreads, and you get the financial conditions index, which actually shows that it's coming back down to levels that have served as this kind of roadmap, as this pivot point in the past for the Federal Reserve. And that brings me to my chart of the day. We are looking at the Bloomberg Financial Conditions Index. If you actually look at this chart for our radio audience, and it goes back, it's in negative territory right now. It goes back to 2018, 2016, 2015, even 2012, essentially these major pivot points where you hear from the Fed after some sort of sell-off in the broader markets that this is time for them to speak. The most notable example being at the end of 2018, Christmas Eve of 2018, where in 2019, they at this very start, they kind of turned, the Chairman Powell turned kind of his posture around, really calming the markets to some degree. Do we get some sense of that again this week, Tom?
Kaylee, thank you so much. Kaylee, Kaylee, I got it. Kriti. And now joining us.
Tongue twister, Tom. You should use that as your warm-up before the show.
Yeah, okay. Now joining us, Kaylee Martin-Adams. She's Chief Equity Strategist for Bloomberg Intelligence. Gina, you've got a team of some 200 securities types you're herding. What is the theme this morning in the Bloomberg Intelligence meeting?
Yeah, well, I think the theme for everyone is still inflation, though the market responded so viciously to the CPI print. The PPI print is actually historically much more important to driving
Why
profit
is that?
trends.
This is the three-level producer price index series. It used to be gospel 30 years ago. You're telling me it's gospel again?
It is. It's absolute gospel for the S&P 500 earnings stream. It is the price that companies pay for their input costs, so it's very meaningful. CPI might represent the cost, the price that they're able to charge, but ultimately the spread between the two is what makes margins on the S&P. And if you think back to where we were this time last year, we were talking a lot about margins as the predominant risk to the earnings stream going forward. Margins do lead earnings. Margins peaked by the third quarter of 2021, and estimates have been leading earnings estimates lower. That's a predominant source of risk in the equity market, even though we are certainly contending with a lot of volatility related to Fed policy, which is also directly related to inflation. Earnings are what ultimately drive stock prices over the long run. So to be in this margin crunch kind of environment is very difficult.
Is it all boats sinking, or with what you just said, are goods kind of companies struggling because of import prices, but service sector companies like software technology, whatever, are not?
It's a very big mix because some services companies are absolutely suffering. The consumer services companies are a good example of that, right? Restaurants, for example, they're not necessarily goods producers. They offer a service, yet they have very high input costs as a component of their overall cost structure.
Well,
not only from goods, but also from labor.
Kaylee, we have to stop the show. Is McDonald's a goods or a services company?
Yeah, it counts as a services company. It's a component of the consumer
Shake
services
Shack
group.
is a goods, and the rest of the bags I get at the door at home. Juice Bar is a service company.
Restaurants are services. You do have goods companies also in the consumer space that are obviously struggling materially as well in the form of retailers.
Tell me sushi's not a service company. It's got to be.
I have a feeling, Tom, that any restaurant you name is going to fall.
All going to be a service.
Kaylee, pick it up. I got to, look at my.
Okay, well, Gina, I'm looking at the markets this morning. An S&P 500 that looks like it very well could close in a bear market today. You have a 10-year Treasury yield breaching 325. We're now at 326. And the only thing that seems like it's safe to buy is the dollar, which is just going from strength to strength. And you're starting to see companies warning about that stronger dollar. We saw it from Microsoft cutting its outlook because of FX headwinds. Is this just an excuse, or is that real?
I think for some companies, it's certainly real. The dollar has this very fuzzy relationship with stocks, to say the least. I mean, in the index at large, 65% of the constituents actually have a positive correlation to the dollar. Those constituents' earnings streams have a positive correlation to the dollar. So most companies in the index actually benefit when the dollar rises historically. Some companies with more multinational focus that may not have been hedged properly are certainly going to experience dollar-related cost weakness or dollar-related earnings weakness, but it's not a story that you can paint the index with one big broad brush with. I mean, the dollar and S&P 500 earnings have almost zero correlation over a long-term time period. But these dollar spikes can be very meaningful. We actually wrote about this for a note that's coming out on the terminal tomorrow.
Well, good.
The
Give us
dollar
a heads
spikes,
up.
when you
No
have
one's
these
watching.
really, really big moves in the dollar, it can be very meaningful. At this point in time, we estimate that every 1% move in the dollar shaves about 19 cents off of the earnings stream. So it doesn't sound like a lot in the grand scheme of things, but you've got companies in tech and materials, some of the consumer space that do have exposure that is somewhat meaningful.
Okay, Gina, just over the course of that answer, I told you the 10-year Treasury yield was in and around 326. It's now about 328. So we are seeing rapid movement in the bond market as well. What does the 10-year yield approaching 330 mean for an equity market that is already in a great deal of pain?
It's very meaningful because the spread between the 10-year and the 2-year has shifted either flat or almost negative again. If we move back into negative territory, it's incredibly consequential for stocks. Yeah. What we tend to use is the 2-year, actually, as our framework for deriving valuation expectations for the index. So the fact that the 2-year is back to 3%, two-year forwards back above 3% again, closer to 330, would imply that your valuation multiple on equities needs to be closer to 14 times earnings to price that kind of rates landscape in. And then you pile on top of that an inverting yield curve or flat yield curve, and that only suppresses your expectations for the multiple more.
Don't be a stranger. I got 6 more questions. Gina Martin Adams, thank you so much. We never got to the idea of cash, where she is the queen of having the courage to stay investing. Kaylee, help me here with the data check. Futures up 533.19. VIX up 5 points, 33.16. And Kaylee, negative 607 on Dow futures.
Yeah, it is painful out there for equities across the board, Tom. This could be bear market territory for the S&P 500 if these losses hold come the opening bell. You're seeing weakness in bonds as well. We are up 11 basis points on the 10-year yield. The move is even greater at the short end of the curve as the bond market adjusts to a Federal Reserve that it thinks potentially could move 75 basis points next month. The only thing stronger in terms of U.S. assets today, Tom, is that dollar. Euro dollar weaker by 0.6%.
Yeah, euro dollar comes in, and I'd also mention sterling having a weak recent 15 minutes, the low 121.69 on sterling. Please stay with us. The real yield over 0.5%, 0.51% on the 10-year inflation adjusted yield. Stay with us on radio and television. Negative 95 on futures. Good morning.
I think what we got is a mid-cycle slowdown, but I don't think we have a recession going on.
This is an inflationary process that has been broadening and deepening out.
What I think that you're ignoring is the adaptability of people and the economy.
The risks of eventual recession are rising.
It's a clear signal from the Fed. We're going up and we're going fast.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
On the brink of a bear market ahead of a pivotal Fed meeting. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, John Ferro, and Lisa Abramowicz. John out. Kaylee Lyons very much in. We're very glad to have you here on this day where we are seeing deterioration. And Tom, as we've been talking all morning, it's been fluctuating and now a leg lower with the Nasdaq down more than 3% ahead of the open.
About half an hour ago, a leg lower. We're breaching through to some new low levels. I'm looking for negative 100 on SPX. Haven't gotten there yet. But Lisa, negative 95 is not the negative 91 of a number of hours ago. We're looking at a tick by tick. And Lisa, the yield space is so out of kilter. When I look at the screen, I'm mixing up like the 2-year and the 10-year.
Well, I think that a lot of people are, because we did see a yield curve inversion, meaning that they were the same. And then even the 2-year yield exceeded that 10-year yield briefly before reverting back to the normal that we hope for. And we're looking right now at the highest yields on the 2-year going back to 2007. What can the Fed, Tom, say in this market?
Well, what they're going to say, and the reading is, and I think of Ibram Habari at Citigroup about 5 hours ago, I'm going to say, making clear they felt 75 basis points is unlikely. It's a parlor game. It's something to talk about, chat about. Maybe you extend it out to July 27, which is just another way of saying you need more data. But what data do they need to? Look at the headline coming out right now with a 328 10-year. We're back to 2011.
And Kaylee, I keep focusing on the Nasdaq because the Nasdaq's pain has been so much deeper than the S&P's in a way that's really reminiscent of the early 2000s of the dot-com crash. Can you give us a sense of what people are doing with that? Because we heard for a hot second that people were going into tech, and then not so much because, frankly, it is just interest rate sensitive, and we are looking at that interest rate sensitivity absolutely get hammered.
Yeah, that has been the story of 2022 so far, why we've seen tech underperforming the broader market to such a degree, because while these companies have gotten a lot cheaper because of how much prices have come in, they are still more expensive than other areas of the market. And do you want to be paying those higher multiples in an environment of higher interest rates that only, if you listen to the bond market and what the pricing is in terms of hikes from the Federal Reserve, they're just going to continue to get higher. So is that kind of duration equity asset something that you want to hold in that kind of environment? By and large, the answer has been no, and you're seeing that borne out again today.
Tom, again, this market has just made some massive moves, and we're looking at deterioration, as you said. But taking a step back, we are looking at a bear market, finally, what people have been looking for. And just to make clear, I know that I've been called bearish across the board and looking for gloom and doom. It's not a positive thing. Nobody wants to see pain in the economy. Nobody wants to see real people struggle. And what we're looking for is some sort of floor to give us a sense of what's ahead. But it's the issue of hiking into weakness that's the theme of this week.
The floor is not there, and the catharsis is not there either. 33.01 on the VIX, 33.01, 5 big figures. SPX futures at negative 91. Dow futures were negative 600 plus, now negative 584. I'm going to hit all the complexes quickly, including BitDog. I'll do that in a moment. The 10-year yield, 3.26%. That's an 11 basis point move, not curve inversion, 5 basis points of normative slope there right now. Crude, softer on growth worries, 120 on Brent crude. Dollar, stronger. Yen, 134.41. I noticed sterling with a BOE this week, 121.76. And copper shows China's not going to grow soon. Lisa?
Honestly, it's been such a rough market. I keep going back to one guest before we went on air. She said, this is getting me a little nervous. Today's trading action. Matt Hornbach has been nailing all the calls of the team with Morgan Stanley, head of global macro strategy there. And Matt, are we seeing catharsis today?
Well, I don't know if it's catharsis, but I do think it makes sense in the wake of an astoundingly strong CPI report on Friday. This economy is going to require higher real yields to slow down and to put some downward pressure on inflation. And that's exactly what we're seeing this morning with yields up across the board, real yields leading the move higher, and the yield curve flatter. One of our key themes at Morgan Stanley has been the flattening of the yield curve, and we do think it will invert again, as it did this morning, and it will invert to levels that we have not seen in decades.
Matt, you are an outstanding student of behavior with your expertise on Japan. Your Michael Wilson is maybe the strategist of the moment with a real cautious call on 2001 into this year. He looks this morning for a change in corporate behavior. Do you agree?
Well, interestingly, I just came from a trip to Japan. I was out there last week with a colleague, Jay Backow, who runs our securitized products research. And, what we saw out in Japan suggests that until you start to get some inflation, you shouldn't expect to see corporations change their behavior. And I think because we have inflation here in the U.S., it certainly makes sense to me that we're going to see some changing behavior out of U.S. corporates. I mean, the dollar strengthening again this morning should ultimately result in some change at the U.S. corporate level.
Okay, well, let's talk then more about U.S. inflation and the Fed's policy response to that. Steve Englander over at Stanchart publishing this morning saying he sees 50 basis points in June, July, and September, 25 basis points in November. He says the reason why he's sticking with 50 is because of indications that activity is slowing down, so the Fed has to avoid overdoing it and having an abrupt about face. The market is also now pricing in rate cuts in the second half of 2023. Matt, is this just a story of the Fed moving aggressively now and then having to cut in rather quick fashion after the fact?
Well, I mean, that's what it looks like in market pricing. But I would just, remind your listeners and your viewers that last year, the market thought the Fed terminal rate would be 1.5% looking out into 2022, 2023. So the forward market has a guess as to what's going on, but it's typically the wrong guess. So I wouldn't spend too much time focusing on what's going on in the longer dated forwards. But to the point of going 50s, I mean, look, the Fed doesn't have much reason at this point to slow the pace of rate hikes until it at least gets policy rates to a neutral setting, which ultimately would imply a string of 50s between now and the September FOMC meeting.
How close is the Morgan Stanley view right now, Matt, to the Deutsche Bank view, a 4.125% terminal rate at some point next year?
Well, Lisa, that's not our view at the moment. Ellen Zentner, who runs our U.S. economics effort, she currently has the terminal rate in the low threes. Mm-hmm. But, let's be honest, things are changing very quickly, and the inflation data is surprising our economists to the upside as it's surprising most people to the upside. So we're certainly not alone in that sense.
Matt, John from Marina Grande Capri, he's asking of Italy this morning. I did a log study, Matt, and it's indicative of some of these stretched series, and that it's what's called log convex, which means the second derivative is increasing to a greater point of tension. How log convex is the market right now?
Well, I mean, ultimately, I think the markets are completely riding on what's going on in the central bank community, and the central bank community is moving more and more aggressively towards tighter monetary policies. Inflation is really the Achilles heel of risk markets, because central banks with inflation mandates have to respond if inflation is going up and might not come down anytime soon. And that's what we're starting to see, is just central banks moving more and more aggressively, and that's going to put upward pressure on real interest rates. And when real interest rates go higher, valuations have to come down.
Matt Hornbach, thank you so much. Greatly appreciate it. With Morgan Stanley this morning. Futures at negative 91, Dow futures negative 589, the VIX 32.97, up 5 at big figures. Lisa, one of our high points in Davos was a banking conversation with a banker from Boston and Bank of America, one Brian Moynihan. B of A out reaffirming here what Moynihan was talking about was, you know what? The consumer's strong. Yeah, the markets are moving. Credit remains really strong. B of A sees mortgage loan growth keeping pace and continuing. I'm lost.
Kaylee pointed this out, some headlines coming from Bank of America, reiterating what we're hearing, frankly, from all of the banks. They're saying credit is holding in there because companies are doing well. Consumers are doing well. It's, to use your word, Tom, the partition between now and then. Now and what's going to happen in 6 months. How do you game that out, given how high rates are, how high they're likely to go, and given consumers feeling crimped by higher gas prices, rent prices, and everything else?
Kaylee, if we get an Ed Hyman 4% inflation out there somewhere and I had 2% growth, that's 6% nominal GDP, which goes back to the animal spirit that Fortress Moynihan is seeing.
Well, and that's what they're reiterating now, is that the growth picture actually doesn't look all too bad at this moment. And I look at these kind of headlines, Tom, and I'm wondering, is that a good thing for the Federal Reserve? Because it means the economy is strong, that they can be aggressive and they're actually going to be able to execute a soft landing? Or is the idea that the consumer is still willing to borrow, still willing to take out mortgages, even as rates go higher, mean that the Fed is going to have a much tougher job actually seeing the transmission mechanism in that higher rates actually slow down activity and bring down prices? If the consumer is willing to spend regardless of what rates are, how does the Fed do its job?
Lisa, look at the real yield. Matt Hornbach mentioned that. And you were you?
Of course I was. He mentioned this.
Well, that's because you drank the Ferro Kool-Aid. 0.51%. It's up 14 basis points. This is it, folks. What this is on radio, I've got the hands thing going. This is the nominal yield moving up much more than the inflation yield, which
that works
gives
really
you
well on radio.
That residual.
It's fantastic. Gives people incredible. What was that thing that you did that one day?
Someone get Tom some pump.
I know exactly. He should just,
No, it's like Big Jet TV. I'm landing a 777.
We're teasing a show that already happened.
Futures at negative 87. Please stay with us on radio and TV. More data checks. Markets moving.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia continued its assault on Ukraine's Luhansk region, pushing Ukrainian troops out of the center in what is Kyiv's last foothold in the area. President Volodymyr Zelensky, in his nightly address, called fighting over a main city there very fierce. Ukraine's top military commander has pleaded with his U.S. counterpart to send more artillery. And Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. A software engineer on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the product. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he breached the firm's confidentiality policy. And crypto lender Celsius Network paused withdrawals, swaps and transfers, triggering a broad cryptocurrency sell-off and prompting a competitor to announce a potential bid for its assets. Doubts about the high yields backing products such as those Celsius offers have intensified after tighter monetary policy across the world helped curb demand for riskier assets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
One of the big reasons why the price of gas is so high in the United States is that refinery margins, the profits that refineries are charging, have hit historic levels. We need industry and the government to work together here to try to get more supply onto the market.
Brian Deese of the White House, Director of National Economic Council there, talking up a gallon of gas, which is truly front and center. We're doing more data checks. We've got a little bit of a lift in a tape that was ugly over the last 45 minutes. Futures were negative 95. They're now negative 85. A little better tape. The VIX up 5 big figures, 32.61. Dollar still ascendant. Euro dollar 104.57. Yen doesn't get to 135, 134.38. Weaker currencies against a stronger dollar. Brent crude 120.42. As Brian Deese was talking about a gallon of gas, there's an entire another story in hydrocarbons. Darwei Kung joins us now, head of commodities, DWS, and we're just thrilled he could join us here on what I've ignored, and I've been remiss on this, Darwei, which is natural gas. No one talks about the price of a gallon of natural gas, do they?
It's much less known, but outside of U.S., I'm sure people are very concerned about high price of natural gas. U.S. natural gas has gone up multiple times of the price since beginning of the year, and the strong demand coupled with a limited production growth and now more robust export demand has driven up U.S. price as well.
You are so good at the fundamentals of all of this and the underlying fundamentals of export-import pressure of hydrocarbons in the United States. Describe right now who's going to win the battle. Do we export more? Do we keep it instead of exporting it? Do we start to import hydrocarbons again?
At this point, in the near term, we are fairly maxed out on export capacity, and that won't change until we anticipate 2024 and beyond. And there are scheduled projects to come online to convert our natural gas into liquid form that can be exported. Our export capacity to Mexico via pipeline is fairly maxed out, and we always have some import and export between Canada and U.S. to deliver gas from places that's less accessible in each country. But most of those pipelines are at maximum capacity. In the near term, we're not going to see a significant dynamic change. Given how low U.S. price still is, compared to the global price, we're less than about between a half to a third of global price. The pressure will be there for U.S. to export more once that pipeline once that capacity to export liquid natural gas increases
Darway,
in the near term.
From natural gas to crude gas, refined goods, gasoline, and diesel, the fact that we're seeing such incredible lifts in gasoline prices, really basically regardless of what happens in the Brent crude market, at what point do prices fall enough for it to actually matter for refined goods, given the lack of refineries?
Well, that's a great question. I think in the near term, we still see strong draws from gasoline inventory. Up to this point, we should have been seeing seasonal build in gasoline inventory as refiners prepare for summer. And we've seen just the opposite. So that natural demand draw will continue. I think that the solution to high gasoline price really comes from demand reduction. We have to see a significant demand reduction to allow for the price to fall. We still see quite a bit of pinned up driving demand, and that's driving the gasoline price right now.
So how long or at what level will that demand destruction really start to kick in? How far away are we from that?
We're anticipating a year from now, we'll probably see less of that recovery demand from COVID-19, ex-China, and that should help with the price next summer. Unfortunately, for this summer, we probably won't see that realized.
Well, you mentioned China. Obviously, COVID-0 still an overhang in that economy. You're still seeing large parts of it dealing with restrictions to contain the virus. Shanghai, just one example. If and when China opens back up, what does that do to this entire supply and demand dynamic globally?
Well, that's a great question. The timing is very important. We do anticipate the additional stimulus program that's well announced ahead of time, both fiscal and monetary, to help with demand growth in China. However, it's very difficult to tell exactly when that's going to take place. Even recently, we've seen additional lockdown efforts again from Shanghai just because of the zero policy, zero COVID-19 infection policy still in effect. Without that being resolved, we don't see the demand coming back up. We do hope, though, in the next 12 months, as the demand go down, we anticipate demand go down ex-China because of all the interest rate moves U.S. has made and other countries are like to follow. We are hoping that the demand from China will help balance that downward movement and keep the price stabilized in the near term.
Darway, Citigroup put out a report overnight where they were talking about how the amount of GDP destruction from where gas prices, where oil prices are right now, is really reminiscent of what we saw in the 1970s. Do you think that oil shock analogy is the right one?
It's similar. We do see both, in both situations, we see sharp rising oil prices, and we've seen artificial constraints on supply, which were resulting, as we have seen before, eventually we're going to see demand destruction. Whether we see a significant destruction that leads to a significant economic downturn or a more moderate, a soft landing scenario, that will determine the outcome of oil price going forward.
Darway, thank you so much. Darway Kuhn with us today with DWS here on commodities. We'll get him back here soon, particularly on the commodity dynamics of China. I can finally report this morning there is a pause in the plunge. The tape is simply better. Even Bitcoin moving out of a 23,000 level back up above 24,000. But Lisa, it's the first time I've got a correlated lift off the bottom and the deterioration we've seen through the morning.
And it's not a retracement, to be very clear. This is simply a lift. It is simply a bottom. It is simply a feeling that perhaps it's not going to keep plunging. It's setting us up for the first bear market that we've really seen. And this is the S&P down 20%. That is what we're poised for. The Nasdaq down much more. At what point do you get capitulation? That is the issue. And that's why I think it's good that you're looking at the VIX. How much does that signal an expectation of volatility, Tom?
Yeah, well, the expectation here is a 32.49, and one of the important insights this morning was a number of guests really looking at 40 level on VIX as being catharsis, and we really don't see that right now. Futures were negative 96. This is S&P futures, I should point out. That's an odd number. Negative 96, now negative 81. So an improvement in the tape. Dow futures were negative 600-ish, negative 512 there as well. And the VIX doesn't come in all that much. Maybe we'll see that in the next 20 minutes as well. The 10-year yield, get used to it, 3.25%. dollar strength, and Brent crude, we do for Darwin Kun, 120.38. Please stay with us on radio and television with more data checks this morning. This is Bloomberg. Surveillance. Good morning. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro off Kaylee lines, pulling the short straw, and is with us today. And the straw that broke the back of this market, well, maybe it was the inflation report or the inflation expectations report. An ugly morning, and there is a bid in the market. Futures negative 96, now negative 83. Dow futures negative 600-ish, negative 531. There's a lift to the tape here. Nasdaq down 2.7%. Excuse me. VIX up 5 big figures, now up 4.73 big figures. Stronger dollar. I mean, Lisa, how strong is the stronger dollar? I mean, it's stronger, but it didn't break out.
Well, it broke out versus the yen, and this highlighted the differentiation in the monetary policies of the two nations, and it's breaking out when it comes to the euro, and there's a question of what the floor will be for the euro versus the dollar, now 104.7. How much do we see this push the stress points at a time when perhaps policy isn't doing the trick? And I point to the Bank of Japan on Friday for that one. Yeah, 134 with a test at 135 on yen. The tang this morning is too strong. We'll let them know. They'll be very concerned. They'll water it down with Velveeta. No, they don't. No, we use Evian usually. We want to, keep it more attractive. This is an important interview. Stephen Whiting cut his teeth with the best profit analysis I know in economics of anyone in the street. He's earned his way into being chief economist at Citi Global Wealth and joins us this morning. Stephen Whiting, let's go to your wheelhouse. Are profits threatened?
Yes. We are in a period of very high profits, and that makes them more vulnerable. We think that 2023 will be a year of decline for EPS. At this point, again, we don't see the need for a plunge in every industry's profits. We don't see a need to unwind all of the gains that we've had over the last couple of years. But clearly the impact of stimulus, fiscal stimulus on demand, bled through into profits in a positive way. That's how we had a 47% EPS year last year. Now, this means downward earnings estimate revisions. This is not going to be a year of 10% EPS gains followed by another next year. I do think share prices already understand this. In other words, the drop is already, to some extent, said that these estimates are nonsense.
Steve, when we get tested like this, do companies that display free cash flow persistency, do they go down with everything else, or do they partition and separate from the gloom?
They do. And it really often comes down to dividend coverage, dividend delivery. Again, it's really boring stuff, but good stuff. If we take a look at U.S. shares that have the most consistent long-run dividend increases, they've fallen half as much as the broad market, and they yield nearly twice as much. So this is an area, again, to hide out in our own discretionary portfolios. We have 11% of all discretionary portfolios, U.S. or non-U.S., and for any asset class, benchmarked to that particular type of style investing. Again, and these were not the companies that could gain in 2020. They weren't the tech solutions, and they weren't the really beaten down cyclicals of 2021. So they didn't perform terribly well for the last couple of years. And we think they're a very good place again now in a market that's far from perfect.
Stephen, what's the distance between now and later? And I look at Bank of America putting out this idea of...
That's just way too existential. What did you say?
This idea that you have a consumer that's strong, you have corporations that are strong. How far is the distance from now to a lesser now, to one that people are forecasting in the prices of stocks?
So look, some of the lagging indicators like inflation will take a long time to roll over. But it doesn't mean we have to assume that inflation will rise forever. And just because consumer fundamentals are firm in many ways, a lot is chipping against it. So we would expect, for example, this slowdown in goods consumption to result in lesser need for employment. So employment growth will be slowing down by later in the year. You won't be able to say that a low unemployment rate is the reason why nothing's going to go wrong. I don't want to seem ultra bearish here, but this is, again, the reasons why I think from a forward-looking perspective in terms of monetary policy, you can't say, well, we need to raise rates until inflation is low. By then, you will have created the forward-looking conditions for a much, much deeper decline in the economy than you're aiming for.
Alan Blinder, the former Fed vice chair, came out over the weekend in a story and said the chair of the Fed doesn't want to let the R word slip out of his mouth in a positive way, that we need a recession. But there are a lot of euphemisms, and he'll use them. Stephen, what are we going to hear from him on Wednesday?
It'll be very interesting because you can't really satisfy markets over short-term inflation outcomes. Again, we've kind of joked around. It's like, well, why don't you raise rates 1,000 basis points? And it's like, what will that do to next month's CPI reading? And there's very little they can do. I think that there has been less acknowledgement than we might have seen. And everybody's probably spending so much time criticizing the Fed. It's too easy for all of us. But supply shocks, periods in which we have instability in the economy. Think about, we were just talking earlier on the break, airfares have shot up by 32% over 2 months. That's non-annualized. Well, what were we seeing at goods prices last year? The same thing. The sources of demand in the economy are too unstable. We think monetary policy can take care of everything. It can't. These are periods where we don't stabilize consumer prices in the short term.
Stephen Whiting with us, and we continue with Citigroup Private Bank. I want to look at a better tape right now. Futures negative 96, up 10 points, negative 86 on futures. Dow futures negative 547. Yields do a little better. Really across the Bloomberg screen, everything doing better. Even the 210 spread from quick inversion 2 hours ago, we're now up 10 basis points on the 210 spread. Kaylee?
Well, on the subject of the 2-year, yes, things have moderated, Tom, but you are still seeing that selling pressure in the short end of the curve. I was just taking a look at what has happened to the 2-year Treasury yield in the month of June. And keep in mind, it's only June 13th. We're not even halfway there, and we're not yet to the Fed decision on Wednesday. That 2-year Treasury yield is up 61 basis points. This is a market that has moved incredibly quickly, Stephen, now to price in 175 basis points of tightening by the Federal Reserve, or hikes by the Federal Reserve by September. So I guess one-word question, 75? And I say that with a little shrug for our listeners on radio.
Well, look, if they're going to do 75, it's better to do it sooner than later when policy is still at a very low interest rate. But it also goes to the fact that they've kind of lost control of the dialogue over this. I mean, they need a monetary policy approach that they can sustain. Just take a look at the history of Fed tightening cycles. Over the last 45 years, when the Federal Reserve reaches its maximum policy rate, it's only kept it before cutting 7 months on average. And if you really wanted, again, to deal with the longer-term inflationary imbalances in the economy, you want a monetary policy that you can sustain. Now, again, you could game this out. Maybe I'm the wrong person to guess this, but if you just had created a shock and awe effect where everyone believes, okay, this is under wraps, and then a couple months later, the CPI is still rising, I don't know what you've accomplished. If you were tightening so much that you have a recession and then you have an easing cycle and you are doing QT, so now you've got to do QE again. This whole approach, again, of the Federal Reserve going from feast to famine and back, again, in a pro-cyclical way. I mean, look, the mistake that was made was easing in a boom last year. You can make 2 mistakes of monetary policy, not just one. So I think, again, trying to satisfy the market and short-term inflation outcomes might be the wrong approach, at least as far as I'm concerned.
Okay, so what you're describing, Stephen, is essentially Jerome Powell with an impossible job, that he just can't do this right. Either you're going to upset the market, but potentially get inflation under control, or you don't want to move too aggressively and surprise the market. Therefore, inflation is allowed to run hotter for longer. Is it that binary realistically? Well, the one thing that we just can't dispute is the fact that monetary policy doesn't have complete control of the economy. There are really positive developments beneath the surface on the supply side. You could see the price of appliances was down. Okay, why? Well, consumer goods production is now rising 4.5% in unit terms. Consumer goods consumption is falling.
Imports are rising 12%. If you want to get through this, we need to get through the next leg of it, which is going to be services, which is going to be housing-related issues. Do you really want to create more instability? I think they're going to be in an environment where they're trying to avoid that and still communicate effectively. Maybe they can't do both.
Stephen Whiting, thank you so much. Great brief this morning with Citi Global Wealth Management here with some turmoil and a little bit of a pullback. Boy, I'll tell you, it's flighty, Lisa. I mean, there's no real bid out there. We just are not going down like we were earlier.
Correct. I think that's a good way of framing it right now. And I think the 2-year yield is really what's driving a lot of this. Suddenly, people are looking at more intractable inflation, a Federal Reserve that has to deal with it. What is Fed Chair Jay Powell going to say on Wednesday, Tom?
Well, we will have to see as well. Lisa, just because I know you're going to wander off to do the open here, we need to send surveillance birthday greetings to Bosa El-Erian. Bosa's ensconced on the lawn at Cambridge. This is the dog of the El-Erian house.
Happy birthday, Bosa.
Bosa nailed the inflation call along with Dr. El-Erian,
No, Dr. El-Erian has been absolutely brilliant on inflation and the tractable. Bosa also, his yapping has been incredibly instructive in our inflation outlook.
They had a cat that thought it was transitory, and El-Erian threw him in the river there. It goes behind the campus.
Most people don't have the same treatment of their pets,
Okay, well, we say birthday greetings there to Dr. El-Erian and the beast. It's a tough life, Lisa. I mean, the dog is like lots of student hugs at Cambridge.
How much are you paying for vet Bill's haircut these days?
You really.
Inflation.
You got an important guest coming up, Lisa.
Yeah, Jay Pawlowski, we're going to be speaking with as we carry you into the open. And again, if this move holds, bear market in the S&P. We'll be speaking with Jay Pawlowski about that at TPW.
Stay with us. Futures at -87, and we say good morning on Bloomberg Radio and Bloomberg Television.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Amnesty International on Monday accused Russia of war crimes in Ukraine, saying attacks on Kharkiv, many using banned cluster bombs, had killed hundreds of civilians. The report citing, quote, repeated bombardments of residential neighborhoods. Ukraine President Volodymyr Zelensky says Russia's death toll from the war could surpass 40,000 in June. Lloyds Banking Group will pay staff more money this summer as the cost of living spirals in the UK. Britain's biggest mortgage lender will make the one-time payment in August to more than 64,000 employees, covering all staff apart from senior executives. That's according to an internal memo seen by Bloomberg. Prices are rising in the UK at the quickest pace in 40 years. The UK's financial regulator has added Credit Suisse to a watch list over concerns it hasn't sufficiently addressed risky culture. The lender has struggled to draw a line under a series of scandals. The Financial Conduct Authority told Credit Suisse last month it was adding the bank's UK operations and international unit to a list of firms warranting close monitoring. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes. But Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential election from his result 5 years ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Of eventual recession are rising, but I think what's clear from all the data that we're getting over the last few weeks and last few months is that this economy is not falling off a cliff today and actually is quite resilient. So I think that eventually those risks are rising, but for the here and now, I think people are getting maybe a little pessimistic too early.
A grown-up book, folks, that you may want to read. Dan Suzuki has the privilege of working with Richard Bernstein, and I can't say enough about a book that is not dated but written decades ago. Style Investing is a really, really smart effort by Richard Bernstein. Quickly, Kaylee lines with the markets moving, futures -90, a bit of a pullback, not near lows, but, there's an ebb to it. There's a real tension in the market. Two ideas. Euro-Hungarian forint has just reached record Hungarian weakness. We don't need to spend a lot of time on this, Kaylee, but this is like, be careful what you wish for in real estate, and that a lot of real estate in Eastern Europe is hinged off this with Swiss banking. So that's worth watching. And moments ago, Julia Coronado, who's just excellent, just taking a sentence out of her note, Kaylee, mortgage rates at 6% by the end of the week, according to Coronado.
Yeah, I'm really glad I'm not in the market to buy a house right now, Tom. But how does that track with the comments we heard out of the Bank of America CFO, Alistair Borthwick, earlier speaking at a conference saying that mortgage loan growth is still keeping pace? It's still holding in there. People are still willing to borrow even as rates go higher. I guess the question is, how long will that remain the case as we see the Federal Reserve continually hiking, potentially even more aggressively in the wake of last week's inflation data?
Right.
When does that start to slow housing in a more material way?
Usually at a dog and pony, if you have to say your trading team is, quote, done great, the radar goes up. It's not a lot of money, but the CFO of Bank of America says leverage finance write-down is about $100 million, something around there. Not a lot of money, but we'll go with it. I demanded after Friday's Zeitgeist, where she was the focus of attention in the markets Friday afternoon. Lori Calvasina joins us now, head of U.S. equity strategy at RBC Capital Markets. What's so extraordinary about the Calvasina view, Lori? What's the distinction that got global Wall Street's attention this weekend?
You tell me, Tom. I mean, I try to keep a cool head in topsy-turvy markets, whether it's to the upside or to the downside. But look, I will tell you, I think we were at a crossroads back in mid-May. We wrote a piece titled that, saying that if the market kind of broke below the 3,800, 3,850 type level, exited growth scare territory, that we'd be pricing in a full recession. We bounced back, and we're right now right back at that crossroads. And I think it's very interesting. The market did not break 3,900 on Friday. That May 19th low actually ended up holding. I also thought it was interesting, frankly, that the small cap space, while it did get hit as hard as the S&P 500, it didn't get hit materially worse on Friday. That's important because we had seen that positioning had already been washed out in the futures market there. The peak in small cap came last March versus large. Right. And, you know, I think we can start to sort of look for areas of the market now that have been de-risked, even though there may be more risk in the aggregate.
We have focused, and we did this to great credit to our team Thursday and Friday, on the 5-year out, 5-year view of inflation from the University of Michigan survey. Lori, you highlight that. If we have a reset to higher inflation expectations, is that good for equities or less good?
I think that it keeps the value trade going forward. And I think that ends up being a destabilizing force for the equity market, simply because we do need that growth side to really stabilize. That's really where more of the market cap is in the S&P 500 these days. But we actually just took a look at how different sectors in the market have traded in regards to that University of Michigan 5-year inflation expectation number. People used to make fun of me for using it. It actually, you know, turned out it was good. We had it to dust off the shelf. But the reality is it's things like energy, materials, financials, and even in the big cap space, REITs, that tend to outperform when inflation expectations are rising. So if that trend continues, it's, you know, going to let this value trade live a little bit longer and keep some pressure on the growth trade, which again is a pressure on the S&P.
Yeah, and we've certainly seen growth bearing the bulk of the selling pressure. The Nasdaq 100 is down 27.5% year to date. But even beyond tech, there's been more pain for one area in particular, Lori, retail. The S&P 500 retailing index is down a full 30 percentage points so far in 2022. Of course, you've heard from Target cutting its outlook twice, the focus really being on margins. When are we going to start to see that bleeding into more areas of this market? Because it started with retail. Does it end there?
It's a great question, Kaylee. And one of the things we point out in our piece is that if you look at the declines we've seen in the consumer discretionary sector, as well as the communication services sector, which has a lot of, you know, sort of consumer sensitive names in it as well, the declines we've already seen in those sectors are very close to the average declines that we've seen in them in the past 4 recessions. Now, what's interesting, if we are headed into a recession, areas like financials, industrials, materials should have been underperforming. That's part of the historical recession playbook, that those cyclical areas tend to underperform heading into recessions, though they, of course, do quite well in the rebounds. Another one that we've been talking to people a little bit about is energy. Energy has, you know, actually done quite well this year for obvious reasons, but heading into recessions, it does normally see decline. So I think it's fair to ask whether some of those winners that we've seen year to date, if this recession fear really does continue to take hold, are they going to continue to see that resilience, or will there be a bit of a catch down?
Okay, so maybe you don't want to continue to buy into areas of the market that have been ripping, Lori, but you mentioned that there are some now pockets of this market in which you've seen enough de-risking that maybe it provides some kind of an entry point. What would those be?
So one place we've been putting people towards is small caps, and we're technically neutral on small cap versus large cap, but we did say if you've been underweight, now we think is the time to remove that underweight and get back to neutral. And really, when we look at the positioning data on the CFTC work, you've been below financial crisis lows. Valuations are cheap, not just in relative terms, but they're also getting pretty darn close to where they tend to bottom out in recent years if you're not in a massive recession like the financial crisis. So we've got a clear valuation appeal. What we don't have, right, is a fundamental tailwind here. This is not really an area you typically want to be in when the Fed is hiking rates, when GDP growth is slowing, when ISM is falling. But we do know that risk started to get priced in very early. And historically, recessions are great buying opportunities for that part of the market.
And for those of you that want to know, Lori Calvasina, catch down is a phrase from CFA level 5. That's where she got that from.
You know where she probably learned that, Tom? The great University of Virginia. She is a fellow Cavalier.
Oh, my word. Pause for a moment.
Yeah, go Hoos.
Okay, Lori Calvasina with us. Thank you. We'll do something at Darden here in the future. RBC Capital Markets. And Kaylee Lyons is as well. Kaylee, there's a lot to talk about here right now. And one of them is the tape gets a bid and then it doesn't. The fragility here is tangible.
It is. We've seen futures kind of stabilizing as we draw closer to the opening bell, in that we remain in this range kind of in and around 3,800, 3,820, Tom. But still at these levels, we could see the S&P 500 opening in a bear market. Of course, the Nasdaq is already there, but it really just goes to show you the concern around last week's inflation data and the idea that the Fed is going to have to be even more aggressive. 10-year Treasury yield, break of 325.
We're going to exit optimistic. Stephen Stanley, Amherst Pierpont, a blistering short note. He's optimistic. Households have massive spending power. That from Stephen Stanley. Thanks to our team for blowing up the show today through the morning on Bloomberg Radio and Bloomberg Television. Good morning.